Yeah, so let's kick off with our opening session. And we want the opening session, the theme for the rest of the day. Um, I'm going to ask all the panelists rather than me, maybe take a minute each to introduce yourselves and then we can, kick off with this. So, Doug, I'll start with you. Maybe like 30 seconds, just introduce yourself and the firm. And we just have all of you introduce yourselves first.
Thank you, Joji. Great to be here. I'm supporting Deal Street Asia. Great crowd here. Thank you for coming. My name is Doug Coulter. I am the co-head of private equity in the Asia Pacific region for LGT Capital Partners. We are a global alternatives firm based in Zurich with regional headquarters in New York and here in Hong Kong. Recently opened a Singapore office, a very small one. We manage $120 billion of alternatives. About 80 billion of that is private equity. And we really invest across the asset class, venture to growth to buyout, small, mid, large, mega, primary, secondaries, and co-investments. To date, we've committed, invested just over 10 billion US dollars here in the Asian region.
Brian?
Congratulations on your first event here in Hong Kong, Joji. Brian Lim, I head Asia for Pantheon. We're a large private markets investor. Been around for 40 years as a firm. Four offices across Asia. Been investing in Asia since the early 80s. The bulk of our activity in Asia, I would say, is private equity. As a firm, we do private equity infrastructure and private credit across different stages, buyouts, growth, and VC. And in addition to investing in funds, we co-invest and provide liquidity solutions in the secondaries market.
Thanks, Brian. Elaine? Yeah.
Thank you. My name is Elaine Chen. I'm a partner in PAG. PAG is an Asia-based alternative manager. We have 3 businesses: private equity, private debt, and real estate. We manage 55 billion US dollars. I'm in the PE team, so we are the troop on the ground. So happy to share.
Jason?
Good morning, everyone. My name is Jason Yao. I'm Deputy Co-Head of Ardian, which is an alternative platform headquartered in Paris, managing about 200 billion, out of which 100 billion was mainly in the secondary, primary, and co-investment. I have been with the firm for 16 years. The business has started in Asia from Singapore, and last year we just opened office in Hong Kong. Out of 200 billion, 10%, roughly 20 billion was deployed in Asia. Very happy to be here, and congratulations again for the first conference in Hong Kong.
Yeah. Thank you, all the panelists. I just want to divide the session into maybe a couple of segments. And one of the points that I touched upon in my opening address was Asia's uneven recovery across different markets. So, Doug, I'll start with you. From where you sit, you've seen, you look at all of Asia. And broadly, when you look at Asia, you see that net cash flows are improving, but fundraising remains under pressure. So, from where you sit, does it actually feel like a real recovery, or what do you think what we're seeing is actually a temporary liquidity improvement in a still cautious Asian market?
Thanks, Joji. And to start, there was some great data up on the screen earlier. Great way to start today. The shorter answer is I don't know. Honestly, but I do know that the asset class, if you think about Asian private equity, of course, it's been around since the 1980s in one form or another. Really, with the rise of Chinese private equity in the early 2000s, that's when things really took off. And then, of course, post-GFC, the rise of China and the interest from Western LPs mostly to hold on to and grasp a hold of the China story really captivated the interest of Western LPs. So when we talk about Asian private equity, actually, very, very often LPs, and we're really talking about Chinese private equity. And between 2010 and peak private equity in 2021, Asian fundraising went from being approximately 10% of global totals to at peak almost a third. So there was a dramatic inflow of capital from the West, mostly chasing that Chinese growth story. Now we know how that worked out. There were some really great idiosyncratic returns generated in China from a few incredible managers and a small number of incredible private equity and venture-backed companies. But overall, returns at scale, we think, disappointed. And I think right now, if you look at where we are, I think both LPs and GPs are struggling a little bit trying to figure out what's the right strategy for Asia. And it is interesting, and we do agree that there are a lot of green shoots in China. In some ways, we think China is the single biggest and most interesting private equity opportunity in the region today. But we also don't want to make the same mistake that everybody made in that 2010 to 2020 decade, where too much capital went into the market. So I think when we step back and look at the broader ecosystem in Asia, we just come back to something very boring, which is diversification. You really need to find, and that's what private equity has always been about globally, you need to find exceptional managers, exceptional companies, and interesting opportunities to deploy capital. Generating great returns in private equity and venture capital has never been easy. I don't think it's going to be any easier going forward, but we know for sure that with finding the right groups to back and the right companies to invest in, good returns can be had in the region.
Yeah, thanks, Doug. Just want to take an extension of that, what Doug said to you, Brian. From where you sit, data shows that there's been some recycling of capital. Managers are returning some money when it comes to Asia. Is that enough to convince you to put in more capital to back more managers here? Or is it because the Hong Kong Stock Exchange is doing well that, this is just the phase of capital coming back?
I think the biggest distinction that I guess we need to make is whether the recovery is broad-based, whether it's just episodic, depending on markets. So I guess for the recovery to be, for us to develop more conviction, I guess in a way, we need to see more evidence of multiple exit routes developing, right? So in the good old days of having strategic exits as well as IPOs, but these days the toolkit of getting CVs, doing some recaps, but not just in one market, across different markets. So I think that needs to happen a little bit more. We're seeing green shoots of that happening across different markets, but I think we need to see more variety in terms of these exits. The second thing I guess we need to see a little bit more of is we see a lot of marquee assets getting exits, and that's great, but I think we need to see that flow through a little bit more. I mean, it's hard to build a fund with 10 or 15 marquee assets. So you will have other assets in there that will be nice bolt-ons for other acquirers. So we need to see more of that flow through in portfolios, not just the marquee assets being sold and catching all the headlines. I think thirdly, and I guess there was interesting numbers that you quoted earlier from the Bain study, but the valuation expectations, I think, have adjusted in some ways between buyers and sellers. But the deal numbers are generally down, right? So that could be symptomatic of either the deal landscape being a bit mixed, which I don't think is the case, but more importantly, could well be a case of buyers and sellers not fully getting there in terms of price expectations. So I think that needs to adjust a little bit more. And finally, I guess the financing markets need to recover a little more. I think typically fundraising numbers still are down. We're seeing a little bit more distinction in terms of how LPs are deciding to allocate their capital. So I think a little bit more recovery in the fundraising would be important for us to get a little bit more conviction that this is a full-fledged recovery. So uneven, I would say at this point in time. Great green shoots in some areas, but more to come, hopefully.
Yeah. So, Elaine, what do you see from a GP's perspective? In the sense that you heard more from an LP's perspective, and PAG, you're across several countries. You do China, you do Japan, you do Southeast Asia, you do India. What are you seeing on the ground? Where do you, in terms of valuations, is it still stuck in the old, the where it was earlier, Are you seeing corrections? And finally, also in terms of where do you see this going?
I think from a GP perspective, we tend to really take a very long-term view on both markets, resources deployment, platform build-outs, because for private equity, it cannot be, a few weeks or a few months to build this sourcing execution capabilities. And when you see the news, it's already too late. So you have to be able to build your convictions based on the market trends at the very fundamental level. So we at the PAG in the very trough days in the 2023, we did deals when nobody came to deal because we believe, for food industries, everybody has to eat. There's no question about it. So you can invest at a very attractive valuation. In 2024, we did a $8 billion US transaction for buyout, where most of the GPs sit on the sidelines. We, at the same year, delivered $2 billion DPI for one transaction, which is Air Power. So you have to basically continue your daily work, regardless what the market sentiment is. And I understand from LP perspective, there's a lot of information on fund flow, geopolitical risk, etc., etc. But what we see is the past. All the data is about the past. What you need to figure out is the future. So now I can see we see very strong activity levels in the deal space. We have about 4 companies actively engineering for exit. We see the buyer universe much more strong than before. In this environment, when you run a very successful process, you can get very good result. So for us, we are much more lead time required for a successful GP.
Got it. Thanks, Elaine. So, coming to you, Jason, when you introduce yourself, you said how you do actively involved in both primaries and secondaries. So, from your perspective, where is the opportunity? Is it backing existing or new managers, or is it secondaries and co-investments? Because there's a lot of secondary transactions that are available in the market.
Right. So I think this primary, secondary co-investment does provide different opportunity set. I think I was talking to many investors globally these days. I was talking to the investors from Germany, from Middle East, from Korea. So the consensus has not been down. What's the most interesting part in terms of opportunities here? If you look at the primary, if it's managers with very robust, solid track record, manage to return capitals, can create values, those funds still quite well, sort of popular in the market. They don't have issues to do fundraisings. But a lot of them still need in the phase to deliver more liquidities to prove themselves, and some vintages maybe the performance is not there yet. So I think a lot of LPs was a bit hesitant whether is the good timing to back on some primary funds. Even for the existing ones, they need to wait for a better timing for the primaries. But for the good ones, I don't think LPs tend to wait, evidenced by a few fund managers you've been talking about, which has been very successfully fundraising. From the secondary, it does provide a very interesting opportunity, particularly now. Overall, I think secondary market is sort of still in a development stage when you compare with the US and Europe. The infrastructure, financing, everything is still in the process, getting more mature, which is good from a buyer's perspective. You have this sort of unbalanced opportunities why buyers has more saying in terms of the pricing and structurings. And very limited capital was dedicated for Asia in the secondary place does create an imbalance of demand and supplies, which is interesting if you can go to the GPs, select the asset, which is very in terms of the qualities, accessibilities, etc. You can really choose the best of the assets through the secondary, which is very interesting for now. We are looking at a lot of opportunities right now. For co-investment, I think if it's a decent asset with cash flow generation, with very clear exit channels, I think we will not shy away from those opportunities. We have dedicated pool of capital looking after those opportunities. So overall, I think it's definitely it's not a consensus among all the LPs. Now is the best time. Come to market. You do primary, secondary, everything. I think a lot of the LPs are watching. Where is the good, interesting sectors, could be the investment type, where it still grows or buyout, still people studying, debating. So secondary or co-investments, when you look at the asset, maybe easier, you have more sort of understanding of the asset, more control of the asset, more visibility of the asset. So easier to maybe to start with, compare with primary, relatively speaking. Again, the bar is very high to invest in this area. So yeah, so
Got it. Yeah, thank you. Thank you for setting the context. The first round of just to sort of give a big picture view. Doug, I want to come back to you. One of the things that you mentioned was in the past when it came to private equity and Asia allocation, a lot of it meant China, or most of it meant China. Now today, when you look at it, which are the other geographies that you think that is working, that's interesting to you? Is it Japan? Is it India, Australia? Where is that conviction today?
That's a good question. Well, we can start with just GDP and size of private equity markets, right? So again, not to dwell on China, but it's a $20 trillion economy and historically has had the largest number of private equity managers, deals, exits, et cetera. But obviously, Asia is a big place. When we talk to LPs in Europe and the US, what we're talking to them about in today's context, I guess we talk about Asia Pacific Private Equity 3.0. It's really equal weighting the four major private equity markets in the region. And for us, that really means China, India, Japan, and Australia. Now, all of those markets are fundamentally different. And we also do obviously invest in Korea and Southeast Asia. They're just smaller markets with a smaller number of opportunities in general. But if you look today at where capital flows are going, we can maybe talk about China later. I'll leave that to one side. India and Japan have clearly been the two hottest markets in the region over the last 2-3 years. India's always been a very expensive market. In the last few months, the market's been taken down a little bit. The currency's down. If you liked India in 2025, you should love India in 2026. For us, India has always been a place to manage the number of relationships. We don't think that if you go too deep and too far and wide, you're necessarily going to be happy with the median returns in the market. But there have been a few exceptional groups, both in terms of private equity, buyout and growth, but also venture, that have really delivered excellent returns. We actually leaned into India a little bit post GFC before Modi was elected. And those vintage years, and don't forget, the most important thing in private equity investing is vintage year. So sort of the vintage years 2012 to 2016 have turned out to be really good vintage years, returns out of India as good or better than China. So India, we think on a go-forward basis, absolutely. Japan, maybe the hottest market in Asia at the moment. We do like it, but we are concerned about valuations in the large and mega end of the market. There are we've talked about the big funds being raised. That's probably going to drive up valuations even further in those $500 million equity check deals and above. So for us, Japan is really a small bid market story. We like it a lot. Valuations are still reasonable. There is a lot of GP formation in the small mid market, something to keep an eye on, but we do like Japan. And then finally, Australia. In some ways, even though it's quite a small economy, it has one of the deepest pool of cycle-tested small mid-market buyout managers in all of Asia Pacific. So we're actually quite big fans of Australia.
Yeah. Brian, I just want you to, have your take on the same two markets, Japan and India, because you've been bullish on them. What are the opportunities and the risks? So one of the things that most GP says, LP says, it's very difficult to get into the right GPs in Japan. That's one. And when it comes to India, we've been hearing so much on the valuation mismatch. So just your take.
Yeah, so I think everyone's talking about Japan and India, and I think it's really important to try and separate the strong macro narratives that you're hearing around these two markets, around all of the good things that are happening there, and then making sure that they don't quickly become kind of crowded investment themes, because every conference you go to, every LP conversation you have, it's very much India and Japan and dominating. So I think it's what we're looking for really is to build conviction, is to see that there are underlying kind of long-term themes such as good corporate governance reforms, domestic consumptions governance reforms, strong demographics, a good capital markets kind of ecosystem, and India and Japan both have many of these in different measures. So I think the right elements are there, but India, we've always struggled, I think, with valuations, and for us in India, it's always been around making sure that GPs remain disciplined on pricing. So I think that's really, really important in a market that's very well intermediated. Operational value add, because if you're not going to be able to pay a cheap price, you'll pay a fair price to a full price, then how you extract value from these companies is going to be very important. In Japan, I'd say, I think local origination, I think, can still give you an edge. I think there's still many parts of the economy that are still untouched for such a developed economy, and it's actually quite surprising. So local origination, sourcing networks, differentiation in that respect, I think is quite important. So we do spend a fair amount of time trying to understand these dynamics. So I think, yes, in some ways, I think one has to be concerned around kind of the euphoria that one's hearing around these two markets in particular, but being very selective around how you pick out what's important in each of those markets is critical.
Yeah, got it, got it. Elaine, from a perspective, one of the things that you mentioned earlier was like uh, food, this thing, everybody has to eat. So is it more, from a GP perspective, is it more sector specific or is it geography specific? Because, and um, there was a story that we covered in terms of private equity. The biggest returns in China came from some bubble tea brands. So just wanted to ask your take is versus job.
Um, I think it's neither. It's the opportunity itself. I think, there are people in this industry responsible for allocating between, geographies and, products. But for us in the private equity business, we recognize that each market has its cycles, has its idiosyncratic risks, which is totally out of anybody's control. You just have to recognize those market goes through cycles, like China goes to boom and COVID and very frozen liquidity and now recovery, and Japan was a low growth market and now very, very hot. So people see these fundamental economic cycles. That's one element we have to just recognize. And second element is the fund flow moves much faster than the fundamentals. So when fund flow moves, it actually push up the valuation. It doesn't change the fundamentals much. So to us, actually, it's a paradox. You like people to give you money to invest, but you don't like it to be too crowded. So for us, we need to be disciplined on the valuation. We need to create special kind of dynamics that we can negotiate the best terms. At the same time, we need to kind of balance different markets. Sometimes there's good opportunity in India, but the second year it's too hot and too pricey, then you need to move on to where the opportunity is. So for GP, our responsibility is to be true to ourselves in terms of recognizing the market fundamentals, opportunity, and execute the best deals. So we kind of more macro driven than macro.
Got it. Yeah. Jason, I just want to quickly ask on China because, from all the three conversations, the China was hardly mentioned. Um, Even when China, despite the pullback, it's still about half, even today, it's about half of the Asian private equity market. So is China too large, too distinct just to be treated as one sleeve in Asian private equity?
Yeah, I think it's most of the people would agree that China is so distinctive that it was separate public, as a dedicated region to allocate instead of like one of the many Asian countries, given the size, given the regulatory environment, given the different exit channels, etc., etc. So it's so very different, but it's too big that you probably need to spend a lot of time, resources to really understand of the market. And so a lot of LPs, that's why they are keeping, even in the past few years when the market is investing everything but China, but still, some of the LPs have constant dialogue with us to understand when is the timing to come back. I think for us, like I mentioned, we have probably different data, but when we look at NAV of the private equity market in Asia, from our data is about still around 80% NAV is China. We were thinking maybe it will decrease over the years more significantly. But in reality, it's more decreased from 84% to 79% the NAV in the past 5 years. I think two reasons. One is the fundraising overall for Asia. Seeing your chart, is decreased from 180 billion to like 50 billion last year across 5 years. So the fundraising overall, the total value has decreased significantly. So which the NAV doesn't increase in other regions that significant to. The other thing is the NAV of China has not created much liquidity, so it's still stuck there. Instead of being realized. Though from a secondary perspective, I think primary-wise, definitely Japan, India, and the Korea, South Australia, and the GPs, Pan-Asia guys covering those countries has been quite. It's a consensus. If you go to China to do primaries, those the market you should not miss. From a secondary perspective, slightly different, given the NAV is the things we're looking after, given it's so chunky for Asia and China. So we separate from the rest of Asia. We look at it as a different opportunity set. And it's interesting because the lack of liquidities, which means secondary plays an even more important role to help those GPs. In return, you get very favorable terms and pricing. Yeah. So I would say it will be, for us, we look at it quite separately.
Got it. Yeah. Thanks, Jason. I just want to shift gears. Doug, let me come back to you in terms of today, the Asian private equity conversation is all about DPI. So in that sense, right, like if you are backing managers today, when does realized is it realized performance the single most important factor for you to back a manager across any geography or any country?
That's a good question. Answer is yes and no. We've said for a little while now that DPI is the new IRR. We as a firm look very carefully at cash flow yields. That's also a new metric that people didn't used to look at, and now they do. And just one word on that. I mean, if we look at our global private equity program, interestingly, the region with the best cash flow yields in private equity is Europe, specifically the small mid-market in Europe, where managers have been able to continue to take control of companies, and then because the companies' EVs are not too large, much easier to find a strategic buyer, sell the company. So cash flow yields in the 25 to 30% range in recent years, even during these years where private equities has struggled in terms of DPI. Now, what's really struggled has been Asia. So if you look in recent years, cash flow yields for Asian private equity have been somewhere around 10%. And if you think about it as an LP, if we allocate to a manager, and 10% cash flow yields means, in theory, on average, it takes about 10 years to get our capital back. So when the manager comes back in 3 to 4 years and wants to raise another fund, either we have to say no or maybe cut the commitment in half. So you really want those cash flow yields to tick up. The good news is that 2025, we saw an increase in cash flow yields in Asia. 2026 is also off to a pretty good start. Now, the million-dollar question is this the beginning of something more sustainable, or was that just a blip? We don't know. But I would say, back to your question, when we look at a manager today, DPI is absolutely one of the top 3 things we look at, but it's definitely not the only thing.
Brian, related to DPI, there are many different ways of looking at it, right? In terms of like IPOs, it could be trade sales, it could be secondary transactions. So there are multiple ways of looking at DPI. It could be continuation funds. So from your perspective as an LP, how do you look at real DPI versus engineered DPI, and does it matter?
Yeah, I think it does matter. I think people obviously, like you said, I think there's a new IRR. Everyone's wanting more DPI from their portfolios, but I think what's really important is how is that DPI being generated and at what cost, right? So I think what we like to see is GPs being responsible with how they generate that GPI. So you can be quite clever around recaps, CVs, and other sorts of kind of tools that are increasingly being used today. If you can still somehow retain the upside of these companies going forward, right? So I think that's very important in this market where there are many avenues for you to try and generate that liquidity. There's a big secondaries market out there. I think that if you look at what's important for when people look at liquidity, it's also to make sure that it's being done with the right amount of transparency as well, right? So not just selling an asset for the sake of selling it because you need to generate liquidity for fundraising, but actually generating it in a way that allows LPs to keep the option open if they're doing it, if it's through a CV, to participate in that growth going forward. Giving people that option, I think, is quite important. And also, I think generally marquee assets is what people are looking to kind of see being retained in the fund, whilst whilst there may be processes out there where people will try and put out there some assets that are maybe not as good. I think that the market these days will quickly find you out. I think the asset class has matured enough these days for participants, for LPs to understand what is a good asset, what's a subpar asset. I think it's important to have a good governance structure around that as well. Good price discovery, I think, is important for existing LPs as well as new LPs coming into the transaction, and good alignment in that process.
Yeah, thanks, Brian. Elaine, from a GP's perspective, how has the pressure changed to generate liquidity in the last couple of years? Do you think it's a lot higher than earlier, and do you see not just PAG but other GPs too taking valuation cuts just to generate liquidity?
I think people probably, I can't speak for the whole industry, but for PAG, we have been very focused on DPI as always. It's just when time is good, market is liquid, you can engineer exit much more efficiently. And when time is really tough, you have to use kind of recap, financing, all sorts of ways to deliver the liquidity that LPs hope to see. But I personally think focus on DPI is very healthy for the industry. It's a perfect alignment of LP and GP interests. It's actually a sanity check of the quality of the portfolio. It's a good, scorecard for the deal professionals, whether their underwriting, portfolio management, and exit are fully up to the standard. So I think, the fittest will survive in this market. So we are very much welcome this trend. And we actually do not like, CV so much. it's too hard to explain, and you face a lot of skepticism. So it's easier just to sell for a fair price to the third party.
Yeah, just related to that, Jason, related to just CVs and secondaries. From your perspective, how much credit do you give managers who can, who can come up with secondary solutions to generate liquidity?
Yeah, I think now the GPs have um, more options in their toolkit. So besides IPO, trade sale, secondary is approach. People often talk about for liquidities. But as mentioned, I think it's so secondary itself. It doesn't really create performance. It's just a way of realize some performance. So it doesn't really, it's the GP should not thinking of it as for the sake of produce some sort of liquidities for smooth their fundraisings, etc. It should really solve the problem. For example, the company itself needs more time to realize the values. Or some LPs does have some liquidity needs urgently. So for us, when we look at the secondary opportunities, GP-led transactions, the criteria, you should be very good asset, should be alignment of interest with the buyer. Also importantly, the reason to explain, to echo your question, should be very simple. It should not be, explain 5 minutes why I want to sell those assets, very complicated, It should be very simple to solve the real problems. So for those CVs, we will, look, take more time to look closely. But oftentimes, when we see the chance that some process was running poorly, there is lack of transparency with their LPs. There is disalignment of interest, and there's no real problem has been solved, but just for part of the fundraising stories. So for those, we will be more cautious.
Got it. So, Doug, what makes a secondary transaction attractive to you other than discounts?
Discounts for starters, but no, it's never just about the discount, of course. So for us, our 27 years of doing secondaries globally, one of our main takeaways is that pricing is the least important thing. So number one is quality of the asset that you're buying or the assets that you're buying. You typically need somebody to manage those assets. So quality of the manager would be a close second. That's also super important. Somebody needs to drive the exit, and sometimes that's not easy. And then third and finally, pricing would be the least important thing. Now, if you can find, like you find from time to time, markets where there's been a ton of dislocation, be it from the macro or otherwise, and you can find quite high quality assets managed by good managers at very attractive prices, then you've got to invest. And that's what we see in China today. So, over the last couple of years, and we're obviously not just buying the market. Jason talked about all of the unlocked NAV in China. That's real. And again, that's all that capital that went into China between 2010 and 2021. Most of it's unexited, and that is an opportunity, right? But you really need to know which companies you're going after. You need to buy portfolios sometimes anchored by those key assets. You can also sometimes buy into portfolios that have a decent amount of public exposure, which is a pretty good way to de-risk the secondary out of the gate. Discounts absolutely, but I would say quality of asset, quality of manager are more important.
And Brian, for you, when it comes to a CV, what are the non-negotiables?
I mean, the asset quality, it all starts with the asset quality. It has to be an exceptional asset that you really see growth ahead. You see an opportunity for the GP to unlock more value. It can't just be an excuse to sell it because a conventional exit can't happen. I think it's really important, obviously, to have sound alignment. That means rolling over of economics, of carried interest, new GP contribution over it, a nice kind of tiered aligned kind of structure around how you generate the upside and capture the upside after that. I think process transparency is really critical as we enter this world where there'll be more conflicts, there'll be more of these CVs happening. I think it's be critical for process integrity to be sound. Otherwise, you'll just capture very negative headlines, and that will put people off, GPs and LPs, from going for these transactions. But I think it needs to have a very clear path for an exit as well. Just because you're doing a CV, you're buying yourself some time, doesn't mean that you don't look at how you're going to generate that exit. I think it's still as important to kind of understand what is the unlock that is going to happen, that time and money is going to bring to that asset, that that's going to unlock it, and who's going to buy it eventually as well, right? So I think that's still critically important going forward as to who's ultimately going to buy it. It can't be just another CV around the corner from that CV. So I think all these aspects, I think, are quite critical when assessing whether to enact a CV or not.
Yeah, thanks for the insight. So, Elaine, if you don't like CVs when traditional exits are tough, what are the other alternatives?
Sorry, your question is.
If you don't like continuation funds and when traditional exits are not easy, what are your alternatives? What are the solutions?
I think the recap is a very big part of our way of generating exit, because we tend to focus on cash flow and cash flow based underwriting. So typically our yield is over 10% for our assets. And nowadays China has really loosened up the LBO rules, so you can leverage 70% with 3 to 4% LBO loan. So those are very, very attractive opportunities to just recap and make sure you deliver capital back to your LPs and continue to find the best window to exit.
My last question to you, Jason, is you're a global secondaries platform. When you look at CVs and secondary transactions in regions like the US and Europe, how different is it in Asia? In terms of asset quality, in terms of manager education, awareness, across all fields.
Yeah, I think so. First of all, for the Asia sellers, Asia LP selling global portfolio, I have to say the volumes has been growing dramatically. So we have been very busy doing transactions with the Asia LPs selling US and Europe stuff. For those type of transactions, it's actually getting very mature, and the LPs are super sophisticated. They understand the process. They ask the right questions. They have the portfolio which really sort of tailored to the needs of the global buyers. So for that, I think now it's growing tremendously and becoming a pillar of the global sellers. So the Asia seller, we're talking about sovereign wealth fund, insurance, family office, etc. For the Asia assets, I think it's still the GPs are well informed of the tool of secondaries, and the LPs locally also asking smart questions about how the secondary getting done and the value getting realized. I would say the infrastructure overall here is still developing in terms of the bank financing, how the process getting done, etc. So there's a lot of proprietary bilateral discussion. And for the buyers, it's fortunate that you can work very closely with the GP to select the assets based on the criteria we just mentioned, and strike a deal with interesting pricing. So this, in terms of the development stage, I think it is relatively, in that space, is relatively premature. Even though it's developing fast, but we think there's a lot of opportunities to strike very interesting proprietary ones.
Got it. Yeah. We just want to take a few audience questions before we wrap up. Any of the LPs in this panel can take it. The first one is, do larger and more established funds have a big advantage over smaller funds? Are niche or specific funds no longer favored?
I can just quickly take that. So we know that a lot of the capital is flowing into large and mega cap. The Bain report itself, I think, talks about, and other studies have also shown that small mid-market in Asia has outperformed large and mega through cycles. So it's probably not great that much of the capital is being vacuumed up by the really large funds. And those funds are going to have to go big elephant hunting, right? I mean, there's only so many large mega cap private equity deals in Asia. So it's going to be interesting to see how that plays out. It is much more difficult for smaller funds. But there are LPs out there that want to back small funds because small funds have outperformed overall.
Brian, you want to take it?
Listen, I echo what Doug just said. I think we're swimming in those waters. I think for us, it's a lot more interesting. I think the dispersion of returns in the small fund universe is probably more significant than it is in the large end of the market. At the large end of the market, you have to compete with strategics and various other players with lower costs of capital than you. So for us as an investor in the mid market in Asia, I think it's that dynamic you showed earlier around deal numbers are down, fundraising's down, exits actually up. I think it's not necessarily a bad thing. It's not a healthy thing for the industry if it continues going down for much longer. But I think there's less competition around in the small end of the market. If you are able to genuinely differentiate yourself in terms of your origination, in terms of execution, operational capabilities, I think that really puts you in a different segment where you can generally generate alpha.
The last question, Jason, do you want to take this? Is the secondaries market in Asia big enough to meet liquidity needs? Are you worried that there are not enough buyers out there?
So we actually like the current situation, which is that you have limited pool of capital, limited buyers. So you have, compare with, the equilibrium, if there's less deals, more buyers. So as a buyer perspective, I think it's more comfort zones that you can cherry pick the best asset. But for more industry-wise, it should be more capitals, secondary capitals, chasing after Asia assets that will be more healthy development of the overall market. If it's only 2-3 transactions like every year in each countries, and it's just the pie is not big enough, right? So we are hoping that in the next 3 to 5 years, there will be more and more global capitals really have their dedicated Asia secondary, to come into the market and create the momentums.
We'll just take one more audience question. What's the rationale for Pantheon to move into private wealth in Singapore, set up a team in Singapore? And why did RDN choose Hong Kong for its new office to connect with APAC? Brian, you want to go first on private wealth and then Jason?
Actually, private wealth isn't new for us. We've had a vehicle listed on the London Stock Exchange that offers daily liquidity, the ultimate evergreen vehicle, since 1987. So it's been around for almost 40 years. I think what we've been able to do is, over time, being able to find different ways to provide access to private equity to different parts of the market. There's commingled vehicles, closed-end vehicles, there's separate accounts for large, sophisticated clients. There are the fully liquid vehicles, listed, and there are also some semi-liquid vehicles. So I think it's just finding different ways to give access to what has been, frankly, a very strong performing asset class as a whole. Mostly confined to institutional investors in the past, and giving it in different formats. I think is one of the things that we've tried to do in different varieties.
And Jason, why did you choose Hong Kong for your Asia office?
Yeah, so we're actually starting from Singapore, so it's the other way around. I was actually spent 5 years in Singapore in my earlier days with RDN. I think Hong Kong is always, we're always thinking about Hong Kong as one of the important offices, but we take approach is going more locally. So we have second office in Beijing, Seoul, Tokyo, and during the COVID, we realized that Hong Kong actually, back then it's not a consensus. Hong Kong is rising up so quickly. But we have very long-term view in Asia, and we do feel that we're a bit disconnected in terms of with the sellers. There's a lot of sellers in Hong Kong. In terms of private markets, there's a lot of wealth. There's a second largest private wealth market globally, and also we see there's institutions like insurance, sovereign wealth has been playing more and more active roles globally. So we decided to, in 2024, we decided to open office. It was actually much better than we expected. So we doubled our hiring account, for example. And also in terms of the plans, I think we keep adjusting our plans. Considering the private, we didn't open office for private wealth, but eventually we feel this is such an important and interesting market, so we are very aggressively expanding the private channel in Hong Kong as well. So yeah, for many reasons.
Yeah, thanks, Jason. We have long run out of time. Thank you to all the panelists. We'll continue these conversations, some of these topics that we discussed through the day in specific and different panels. We have sessions on private wealth, private credit. We have sessions on India, Japan, all of these. So do stay on for the subsequent panels and the conversations. And I hope that and I hope the opening panel was able to set the tone for the rest of the day. Thank you, Doug. Thank you. Brian, Ellen, Jason for joining me for the opening panel. Thank you.
Thank you, everyone. Before you stepping off the stage, please stand and have a group photo together. Thank you, Mr. Joji and our wonderful panelists for setting the bar so high with our opening discussion.